Welcome back, folks. The Ray program. Glad you're here. They're playing our music, Gene. They're playing our music, my friend.
Yes, unfortunately.
844 Ray Show. Gene Pastula, certified financial planner. I'm sure you were listening attentively when I was talking about the possibility of the life expectancies going on and on and on. As you know, right now, a healthy, wealthy couple, that is wealthier than average couple, has a 50% chance nowadays that one or the other will live to age 95. The more affluent, I mean, actuarially speaking, I got that right from Mr. Wade Pfau's mouth. Well, he said it in one of his newsletters or whatever. But a 50% chance, that means half of wealthy or wealthier, I should say, 65-year-old couples. One of them is going to be alive at age 95. That is a scary stat. And then I am reading from Mr. Michael Robinson about how they've discovered from, you know, these Nobel laureates, MIT, Harvard, Scripps, Johns Hopkins, and they've found this gene that could cause people to live one heck of a lot longer, reverse the aging, and you are in the business of helping people make sure they don't run out of money before they run out of time with insurance products that do that. This is really going to mess up the insurance company actuaries, is it not?
Well, actually, I don't think so. I mean, it won't mess them up. It might change the dynamic somewhat, and I mean, it's all math. And so, you know, if you have a average life expectancy, if half the people are going to live to 95 and the other half are going to live to 85, then you just have a different target age, and you know, the products that they are selling and offering, you know, have a different value set to them because they're going to be required to guarantee longer life. You know, I don't know why anybody, you know, well, in fact, most people who get past 70 or 75 don't want to live past 95. I mean, you start to get to a place where you've been there, done that, and what are you going to do for the next 30 years after 95? Especially when, you know, your bones are getting weak and
but they're saying they can reverse that. They're saying they'll be able to reverse that eventually, and you'll be like a 30-year-old.
Well, I guess basically when you ask me what I think about that, I think that I'll wait and see what that quality of life is past, you know, any place past 90. It's, you know, if you've got a good quality of life and you're healthy and all the rest, that's pretty good because you got a great deal of wisdom. I know that because I've noticed my own level of wisdom constantly increasing.
Yeah. I noticed that myself last night when we had dinner.
In fact, your wisdom,
my mother. After a couple of cocktails, your wisdom got even better.
But you notice I couldn't add the check right.
No, that's true.
Waiter had to add it, you know, for me.
Gene Pastula, certified financial planner. But it would impact pricing. So, you know, obviously, if people are living longer, it's going to impact pricing. I remember a study from Dr. Moshe Milevsky a couple of years ago, some years back now, maybe 7, 8, 9 years ago. And he came out and said, all these insurance companies that were selling at that time variable annuities, and with all the high fees and all that stuff, and he shocked the entire financial world by saying the insurance companies aren't charging enough for the guarantees that they're awarding inside these contracts. And people went, yeah, charging enough? Are you kidding me? 1.5%, 2.5%, whatever percent? That's a lot. And Milevsky actually had the last laugh on that one, didn't he?
Yeah, and it wasn't very funny.
It wasn't funny at all. But those that bought the contracts, those expensive contracts, and locked in at the lower prices, were really had the last laugh because the market collapsed shortly thereafter, and these insurance companies were on the hook to deliver a 6%, whatever the number was, retirement income for the rest of a husband and wife's joint life expectancy on an account balance that had dropped by 50%. Wow, that was a pretty good deal.
Yeah, the account balance dropped to 50%, but the basis for the income didn't drop
Exactly.
50%. So now instead of 6%, they were paying out 12% of the actual money that was left in there. You know, it's really interesting. I think the most important thing about this kind of information, because obviously we don't know how accurate it is, and there's predictions about time frame and all the rest of the stuff that you know, may or may not happen. But the biggest point is that clearly our life expectancy and the ability for them to keep us alive or help us live longer is there constantly, and so we can count on, unless we succumb to some major disease that still hasn't got a cure, we're going to live longer than we probably ever expected to. That being said, you do not have an annuity type of instrument in your portfolio that's providing you with a guaranteed lifetime base, you are going to spend all of your life constantly concerned about what's going on in the market, whether the Dow went up this year or didn't go up or went down. And the interesting thing that I see, which just blows me away, is whether it's 4% or 3% or whatever, that Wade Pfau is talking about, you can withdraw from your portfolio. Okay, so think about this. For the last 40 years, you've been building wealth and creating more and more and more money to live on. Now you get to be in your 60s or early 70s and you want to live on it, and your advisor says, okay, you have $1 million, we can give you 3% of that a year. That's $30,000.
Which is really disturbing, because the advisor says, and I'm only going to charge you 1.5% to manage the money.
Yeah. So, and you say, wait a minute, I got $1 million and you're going to give me 30,000? That's it?
And keep 15 for yourself?
Yeah, well, and whatever that comes out to be, yeah. And I'm thinking, I can't spend my money. That's my money. I want to spend it. And he's saying, yeah, but if you do, I can't guarantee it'll last as long as you do.
Yeah.
Well, first of all, why don't you set it up so that part of that money, let's say $500,000, you can spend any way you want? Because I guarantee you, the difference between age 70 and age 80 and how you live and what you want to spend and what the price of your meals out are, truly, you old guys think about, do you still get the biggest kick out of a steak at the age of 81? When it sticks between your teeth and it
and your
makes you
teeth
nuts,
fall out,
and you can't sleep.
No, you're 100% right. And by the way, so you're not a scientist, but there's been lots of scientific research on that, and I've talked about it many times. David Blanchett, Ty Bernanke, I can go on, Saltzman and Ticino, they've all done these studies that say exactly what you have said and experienced, and I have experienced anecdotally, and that is we spend less as we age. So when we come back from this break, we're going to dissect this a little bit further and see if, in fact, that Gene agrees with me that you should not wait, as many people do. They say, well, I'll just wait and buy this annuity when I'm older. But if the pricing could potentially change to your detriment, why would you want to wait when there are products that will actually give you some potential for guaranteed growth rather than waiting? So Gene Pastula from SafeMoneyMonitor.com. You want to check him out there too, by the way. SafeMoneyMonitor.com. He does all of this stuff for you, and he doesn't even charge you. 844-RAY Show if you want to speak with Gene. We'll be right back.
Yeah, you really got me now.
Barron's recently did an interview with researcher Wade Pfau. Retirement Rules Rethinking a 4% Withdrawal Rate was the title. And this is interesting. As I pose this to my special guest in studio, Gene Pastula, certified financial planner. The 4% rule, by the way, was first introduced back in 1994 by a fellow by the name of Bill Bengen. And it quickly became conventional wisdom within the financial planning community. But Pfau said this. He said the rules suggest that if a retiree withdraw 4% of their portfolio in the first year of retirement and adjust that initial amount for inflation in subsequent years, they'll have a low risk of depleting their portfolio in 30 years. And he goes on to say things have changed since 1994. Today, with regard to lifespans, there's a 50% chance that one member of a high-income group, 65-year-old couple, will live to 95. So now, Gene Pastula, we have two issues at stake here. One is you hate 4% because you don't want to amass this massive wealth and have somebody tell you now all you can spend is 4% plus inflation. And then you also hate the fact that, people could potentially run out of that money at some point in their lifetime. So how are you addressing this with your clients?
Well, actually, when you think about it now, and they're talking about doing it at 3% and all the rest. First of all, I totally reject the inflation part of the deal because I have watched retirees for years and years and years, and they do not, unless you're at the very, very bottom of the ladder here, they're not impacted with inflation like the rest of the world is.
I agree.
So, the car they bought 5 years ago is going to last the rest of their life type of thing. Mm-hmm. And they don't buy new suits of clothes, et cetera, et cetera. So that isn't an issue. The issue is that now we're getting down to a place where you're getting close to a place where if you're only spending your interest and you're going to leave that principal there, I mean, you've got all that money that you're not able to tap and use for your lifestyle. And if you use an annuity says, the insurance company basically is saying, look, you give us your money, we'll add an interest rate to it, but we'll divide the money rather than based on the interest rate that is prevalent at the time. We're going to divide that money by the number of years that we expect you to live. And we're pretty good at estimating that. In fact, we're willing to stand by it with our checkbook. So now you take somebody who is 70 years old and they have a expected life expectancy of 13 years. You divide that in there and you're closer to 7 or 7.5%, which is kind of close to what the annuity rates are at that point. And what they're saying is, if you live past that, don't worry about it, even though if you did it yourself, you would have used up all your money, and that's what your advisor is afraid of, because his 1.5% goes away. But the other thing is, we'll continue to pay you as if you still had money. And I mean, there isn't a better deal around. Now, I'm not suggesting that people take all of their money and give it to an insurance company and do that, but all the money you put into Social Security, that's what it's doing. It's an annuity. Civil service people, all those pension plans, that's what they're doing is annuity. Some of them are actually giving it to insurance companies, the smart ones, and the rest of them are having the city council manage it or something, but they're really good, But the point is that is the way to do this.
And you know what? There's tons of academic support for what Gene Pastula is talking about because we know that this is the right thing. So the takeaway here, and I want to get to healthcare in just a minute because that's the one bugaboo in this whole study, and Wade Fowle does talk to Barron's about it. But the takeaway here is to take some of your wealth and annuitize it so that you can invest more aggressively the balance of your wealth. And the balance of your wealth could offset inflation if you actually do experience inflation, can leave a legacy to your heirs. And what Financial Research Corporation and others have determined is that by annuitizing a substantial portion of your retirement wealth, at least covering the essential expenses, not only do you have protection from longer life expectancies, but depending on how long you do live and how you invest the balance of your portfolio, your heirs actually could end up with a higher terminal value, as they call it, of your inheritance or legacy than had you not done that. And that's what people are so concerned about. They say, well, the insurance company is going to eat up all of my principal, and therefore there will be no money left over for my kids and grandkids. And that has now been refuted, depending on how long you live and how you tweak the balance of your portfolio, because you don't have to be as super conservative with the rest of your portfolio. That's why this works so well.
Yeah, that's a fallacy that people in the financial business have. It's you do it all my way, or you do it all the other guy's way, and it's just a natural reaction, I think, that they do it this way. But that's not the way you do it. You use different products and different strategies for different pieces or issues that you're dealing with in your retirement planning. And it's and the other thing is that annuities are not going to get better as we go along. As interest rates continue to lag in this area, even if we have a 100% increase, a doubling of interest rates, we're still, below where interest rates are a positive factor in the world of finance.
Okay, so here's what else is in this interview with Fowl. They ask him, where's a good starting point if 4% isn't? You brought this up. He says for inflation-adjusted spending, 3% is a better starting point. Well, you've refuted that, and I agree totally with your whole assessment on inflation. But then they say, well, are medical expenses and long-term care expenses baked into that 3%? His answer, no. That's an extra amount on top of what you need to cover for your normal lifestyle expenses. And the EBRI, Employee Benefit Research Institute, says that a 65-year-old couple should save between $241,000 and $326,000 just to cover medical expenses and drug costs, and that doesn't include long-term care. So now I know this is an area of your specialization. You created, pioneered, and invented a long-term care insurance program 25 years ago that is a balance, an asset balance sheet transfer to cover a lot of those issues. Talk about that.
Yeah, this is the way we take the stress of stock market investing off the table. We have so many different ways we can suck in your money into insurance contracts to protect everything. You won't have any more money
there you go.
to invest. But assuming you do, the $250,000 or to pay for medical bills, I think is, well, it might be there. But I think the real challenge is the long-term care, because it is really expensive, and the statistical likelihood of using it is so high. Government statistics show 70%. So we have assets, we have products now that can use a life insurance policy as a way, because you get great leverage putting money in a life insurance policy, and when you die, the value is way, way higher, no matter when you die. Well, what if you just used the life insurance policy and had a provision that says, yeah, but before you die, if you need long-term care, we'll pay you that money.
So you tap into the death benefit
so
early.
You can take $100,000 and create a $300,000 or $400,000 value if you need long-term care. And if you don't, then the $100,000 plus a respectable rate of return will end up going to your kids. So you don't lose the money, and you can get the money back in most cases whenever you want, and that type of thing. So between those two, the annuity and this, you can take a portion of your money and then invest the rest and invest it more aggressively.
There you go. Gene Pastula, if you want to learn about either or both, or just do an analysis of where you stand and how you might be able to take advantage of safe investments that don't go down in value, then go to Safe Money Monitor. Gene specializes in that. He actually specializes in it for thousands of brokers nationwide. They rely on him and his company to get them the best in product. So if you're interested in that, go to safemoneymonitor.com and just ask for Gene or give him a buzz. What's your phone number? You remember it? Now just go to Safe Money Monitor. He's getting old and he's starting to forget things. Just
I have
like
my
me.
name written here just in case.
Oh, is your name Hart? Whatever. We'll be back. JC Penney.